What if I told you the government just raised billions of dollars in minutes, but there's a hidden cost that could impact your wallet? This is Kenya News Update today. Coming up, you'll discover why investor interest in government debt just exploded by over 20%, and the critical warning sign in the rising interest rates that could signal trouble ahead. The Bank of Ghana's latest treasury bill auction just concluded, and the numbers are staggering. Investor interest shot through the roof, with total bids accepted hitting a massive GH cents 1 billion. That's a full 20.41% higher than the government's target of GH cents 5 billion. But here's the twist. While the government is celebrating this cash influx, the yields or interest rates are starting to creep up. This isn't just dry finance. This is a high-stakes signal about the economy's health and where your money might be safest. Meet the 91-day Treasury bill. It's the star of the show, attracting a colossal GH cents 54 billion in bids with GH cents 53 billion accepted. That's the chunk of the action. For the 182-day bill, GH cents 1.06 billion was tendered with GH cents 1.05 billion accepted. And for the longer 364-day bill, GH cents 1.50 billion was tendered with just over GH cents 1.4 billion accepted. The government is swimming in cash, exceeding its target with ease. But here's what nobody's talking about: the quiet, steady rise in the cost of borrowing. And then something shocking happened. The yields moved. The yield on the 91-day bill increased by a basis point to 11.17%. That of the 182-day bill also went up to 12.61% from 12.55% the previous week. This is the part that will blow your mind. Investors are throwing money at the government, but they're demanding a higher return for their risk. It's a vote of confidence with a price tag. However, the yield on the 364-day bill declined by 3 basis points to 12.9%. This mixed picture creates a puzzle. Why are short-term rates rising while a longer-term rate dips slightly? It suggests investor uncertainty about the near future. They want more reward for locking money away for just 3 months, but are slightly more comfortable with a 1-year outlook. This is a seismic shift in market sentiment. The implications are huge for every Kenyan watching economic trends in West Africa. This isn't just Ghana's story, it's a case study. When a government borrows this much this easily, it can fund projects, but rising rates can squeeze the budget and signal inflationary pressures. The controversy? Some see this as a strong, liquid market. Others see it as the government becoming addicted to expensive short-term debt. The unanswered question is, what happens when investors stop being so generous, or when the rates climb too high? Do you think this investor frenzy is a sign of economic strength or a dangerous debt trap? Drop your take in the comments. Subscribe to Kenya News Update today for more breaking financial news that connects the dots across Africa.